Hello everyone, my name is Dhruv Malani and from today we will be starting our Indian stock market series where we will be covering everything from investing to trading. So before getting into that topic, first I would like to talk about money in general. What is the psychology behind money for us as a human beings and what psychology needs to be when you are entering stock markets in India or anywhere. It's only like I'm telling from the perspective of a trader as well as an investor that what can you expect from markets and what should be your real expectations. So I think money is not quite old of a concept for human beings. It's been 500 years that all this gold coins came into existence, and slowly we started printing the paper money and coins, copper coins, and so on and so forth. Today we have digital money in the form of UPI and Bitcoin, so we can do transaction within no time. But what is our psychology behind money is that uh, according to economics, MPC, marginal productivity of consumption, is higher when a person earns a less income. What I'm trying to say, if for example you are earning, let's say 20,000 rupees of income, you will be more adverse to spend that particular amount, like 18 to 19,000 of your income or 15,000 of your income, because at this particular level your consumption needs is much higher. But and so, in other words, your marginal consumption on income is much higher when it comes to when it is low income. But as a person grows in life and when he starts earning a lot of money, the MPC reduce quite heavily, because when you earn a lot of money, for example, if you will be earning after 20 years 1 crore rupees of package per year, you won't be spending all that 1 crore, because all your basic necessities of life will be filled with the amount of money that you have already earned before. So you will be investing quite a lot of you will be saving a lot of money at that particular time. But what we should learn is the game of compounding. Why one needs to and should invest and trade in stock markets at a very young early age. We can see from the example of Warren Buffett that he started investing at the age of 11, and then he still cries about that I should have started earlier, because he got all that compounding effect from his journey. And today at somewhere around 90s, he's somewhere around 92 and 95, and now he is one of the top billionaires on Forbes list. And he got into that list with just investing into markets. His heavy bets were on Coca-Cola when Coca-Cola used to sell some 25 bottles. At that particular age, he invested money into Coca-Cola, and because of that investment journey, he is able to get billions of dollars just as dividend. I will tell you everything about what I'm trying to say, but we will try to delve into this topic that why exactly you should start early. Let's take a scenario that why should one invest and what are the assumptions of it. I'll be covering all these contents, what you can see on your list. First, we'll get into the need to invest. Let's discuss why investing is crucial. Imagine you earn 50,000 rupees per month and spend 30,000 on living expense. You save 20,000 monthly, but without investing, what happens? It'll be somewhere around 2 crore rupees of some investment. What does that mean is 2 crore 40 lakh. You are not growing that money. You're just saving that pile of money into your bank accounts in the next, and we will assume that you are going to retire at the age of 50. Okay, so your age is 30 right now. You are going to retire at 50. You have 20 years of horizon, and you are saving every month 20,000 rupees, which adds up to 2,40,000 rupees a year. And if we assume that your income grows at 10%, so that will be additional. So every year we are assuming that your 50 sorry for your 6 lakh rupees of uh, annual income, you will be getting an upward of 10%. That'll be 6 like 60,000 and so forth and so on. What you will be quite surprised with that 20,000 you saved monthly for the next 20 years, you would have made somewhere around 2 crore rupees of 2 crore rupees of money. But if you would have gotten an extra 12% return on the 20,000 rupees, an extra 20,000 rupees pay, you would have gotten a 12% annual interest rate. You would have got somewhere around 4 crore rupees of savings. So that's more than 2.4 or 2.5x. So what I'm trying to say is that 20 years down the line, you should be investing that sort of money into some kind of instrument. And what are these instruments exactly? It can be gold, it can be real estate, it can be equity. But why you came into this particular session? Because what I'm trying to tell you is that from the past, all this data, if you see from the past 50 years, on an average, Nifty 50, just our 20 companies ka index gave an annual return of 14 to 15%, and gold gave somewhere around 12% to 10% interest, percentage per annum ka growth, and government securities, the government bonds gave 5% growth. So you can clearly see from this example that investing in just equity would have given you almost a jump of 2 crore rupees, while investing in different instruments would have gave you less amount of money. So only enough for, if you would have saved that 1.7 cr, the calculations were here, that 20,000 rupees, if you would have saved for the next 20 years, it would be 1.7 cr. And like 1.7 cr, and if we are assuming that your expenditure will be somewhere around 30,000 rupees a month, it will actually, like, you will have only 8 years of post retirement. So like, so you will be able to live with that money for the next 8 years, till 58 years of age. So, what are the benefits of investing? The benefits of investing is you beat inflation. If your money that is saved in your bank account, actually because of inflation, it gives negative return to you, because bank is giving you somewhere around 2 to 3% on your savings account, and the current rate of inflation, I won't go with the actual data, but in India, exactly, it will be somewhere around 12 to 10% inflation every year. Like, there's an increase in 10 to 12 percentage of expenditure every year. So there's no way just by saving that pile of money into your bank account there would be any good for you. What you should do instead is you should invest, and because of investing you will be able to create wealth and meets life's financial aspiration. You want to, do your child's education, marriage, purchase a house. Like nowadays it's purchasing a yacht and buying some expensive mansion near the beach. So these all aspirations you will be able to fulfill if you invest in any type of instrument. So now the question comes is where to invest. So there are different asset classes that I was talking about. Depends on your risk and return temperament, you should choose that particular asset class. For example, if I will talk about fixed income instrument, that is government bonds or government or bonds of publicly traded company, government company, PFC, REC, that will give an yield around 5%. I was talking about, but the expected returns will vary, and it won't be able to beat the inflation if you see on a larger picture. So investing in this particular fixed income instrument won't be good for a person who is at the age of 25 to 30, who's willing to take more risk in life, because at this particular age you can afford to lose. But at the age of your, parents' age, that they won't be comfortable. That's why all our Indian parents obviously love to invest in FDs, because they gave a stable return without any type of risk exposure. So that is about fixed income instrument. Now there is equity investment. Definitely there is 100% chance that maybe an investment can go into zero. I'm not telling about that, but obviously it's very highly risky investment, but the amount of risk obviously dilutes with the amount of return it gives. No capital guarantee, but potential for high returns, almost 14 to 15% CAGR, and it is just investing in index funds. I'm not even talking about stocks. Like I've been into investor trader from last 3 4 years, and some investments gave me around 200 300 percentage return in 2 years. Imagine that kind of boost. Like if you compare it with FD, no FD would be able to reach that much percentage of return until unless I'm alive. So long-term investments in well-run companies can yield over 20% CAGR. One good example, I'm not promoting any kind of investment. One good example which gave yield over 20% CAGR. That means every year is Deepak Nitrate. Importance of identifying investment opportunities. So it's very important for you to identify which type of investing opportunities you're looking for. So first, that involves risk. A fixed incomes comes with low risk to moderate risk. Equity comes with high risk. And same for gold as well, but gold is unpredictable kind of a thing. I will consider it as moderate risk. Returns, fixed income give a predictable like 8 to 11 percentage return, but I would cut it down to 6 to 7 percentage return because including all the charges that you have to incur. And equity comes with variable potential for high returns. It can be, on an average 14 15%, but as high as 100 to 200% per annum. And liquidity, fixed incomes have moderate. It depends on the instrument. For example, the like government is issuing some thousand bonds for 25,000 rupees. So the number of quantity is just thousand. So there is not much liquidity. But in equity, it is highly liquid asset because at a particular time, if the markets are open at a particular time, there are crores, billions of dollars are, punching, buying, selling. So 100, it's the most liquid place, I would say, especially for index funds, especially for the top Nifty 50 stocks. There is so much liquidity in any kind of stocks that are present in Nifty 50. Nifty 50, by the way, is the top 50 companies in India which are listed on stock market, NSE. And investment horizon. So fixed income instrument have short to medium term horizon. For example, some kind of government bonds give 3 months, 6 months, 9 months, 1 year, 5 year. So these are different fixed short to medium term ka investment horizon. That means your money will be locked up for that particular time. But in case of equity, it is medium to long term for optimal returns. In order to get more returns, how Warren Buffett was able to do all of this, like he became billionaire because of his long term investment. He never sold his particular holdings in big companies that he started investing in. Just because of this particular habit, he because he got all this long term capital gains, because all this compounding effect goes through it when you hold a particular thing for a longer period. So but obviously there's no particular time horizon. In case of equity, you can buy and sell stocks in a day. You can buy the same stock in the morning and sell it in the afternoon. So because of this, there's no particular investment horizon for equity as per. So what is the conclusion that we get from all this session today? That we have learned the importance of investing to combat inflation and achieve our financial goals. We have some kind of financial goals. We want to buy some kind of gadget, buy some house or buy some expensive car, obviously. So in order to, achieve all these financial goals, one should learn the importance of investing that too early in life. We have explored different investment options, comparing the safety and steady returns of fixed income instruments with higher potential returns and risk of equity investments. At around an age of 25, like it's my opinion that one should, diversify his portfolio in such a way that almost 50 to 70% should go into equity, approximately 25% should go into fixed income instrument, or I would say gold, and 15% should be in cash, liquid. That for emergency situation or any kind of situation, you should have that much corpus of money into your hand. So understanding these differences help in making informed investment decisions based on your risk tolerance and financial objectives. So this is all from my side, and one thing I would like to tell that start early. It will give you an edge before anyone else, and you should have that knowledge so that if anyone other than you, like if anyone who is outside your circle who doesn't have that knowledge, you can give that knowledge that you should invest your money into this particular kind of asset, so that his or her money is not eaten up by inflation. And that is from my side. Thank you for watching.